Hey, what's up? It's Ben here. So you've probably have heard of the phrase balance sheet at one point or another. If you're new to the finance world, it may sound like some kind of gymnastic move or a kitchen appliance, but don't worry, understanding balance sheet is actually pretty simple. At its core, a balance sheet is just a way to keep track of a company's financial situation. It shows you how much the company owns, aka its assets, how much it owes, aka its liabilities, and how much money would be left over if it sold everything it owns and paid off all of its debt, aka its equity. So why are balance sheets important? Well, for one thing, balance sheets can be a useful tool for investors. By looking at a company's balance sheet, they can get a sense of how financially stable the company is and whether if the company is a good investment or not. Additionally, balance sheets can be beneficial for the business itself by keeping track of their assets, liabilities, and equity. Then they can make a well-informed choice about things like taking on additional debt, investing in new machinery or real estate, or selling off assets that they no longer need. If you're feeling a little bit intimidated by all of this, don't worry, I'll be breaking down each component of the balance sheet in more detail in this video. By the end of the video, you have a better understanding of what are balance sheets, and again, there are three important parts to the balance sheet. They are the assets, liabilities, and equity. So let's dive in and start with assets. In the context of a balance sheet, assets are anything a company owns that has value. This could include physical items like buildings, land, or equipment, or it can include intangible assets like patents, trademarks, or copyrights. The value of the asset is typically determined by its market value. In other words, how much someone would be willing to pay for it. For example, if a company owns a piece of land, the asset value would be based on how much someone would be willing to pay for the land if they wanted to buy it. Now, there are two main types of assets that you'll see on a balance sheet: current asset and non-current assets. Current assets are things that can be converted to cash relatively quick, typically within 1 year. This could include things like inventory, accounts receivable, aka money that's owed to the company by its customer, prepaid expenses, or just cash on hand. Non-current assets, on the other hand, are things that the company owns that are expected to last for more than 1 year. This could include things like buildings, land, or expensive equipment. It's worth noting that not all assets are created equal. Some assets may be more valuable than others or may be more important to the company's overall success. For example, if a company relies heavily on a particular piece of equipment to produce its product, that equipment may be considered a more valuable asset than some of the other items on the balance sheet. So in a nutshell, assets are anything a company owns that has value. The next item on the list is liabilities, and they are things that the company owes to others. This includes things like loans, accounts payable, aka money that the company owes to its suppliers, or wage owed to employees. Like assets, liabilities are typically divided into two categories: current liabilities and non-current liabilities. Current liabilities are things that the company owes that are due within 1 year. This could include things like short-term loans or bills that they need to be paid off. Non-current liabilities, on the other hand, are things that the company owes that are due more than a year in the future. This includes things like long-term loans or bonds payable. Now, it's worth noting that not all liabilities are necessarily bad. In fact, taking on some debt can be a smart business move if it allows a company to invest in things that will help it grow over time. However, if a company takes on too much debt or over leverage and they aren't able to keep on with its payments, then that could be a sign of financial trouble. That's why it's important to keep an eye on both of the company's assets and liabilities when looking at the balance sheet. So overall, liabilities are things a company owes to others. And lastly, the third part of the balance sheet is equity. Equity represents the amount of money that would be left over if the company sold everything that they own and paid off all its debt. In other words, it's the company's net worth. Equity is often broken down into two categories: contributed capital and retained earnings. Sometimes you'll see common stock, preferred stocks, or even treasury stock in this section, but the two categories I'll be going over is contributed capital and retained earnings. Contributed capital refers to the money that the investors have put into the company in exchange for ownership, aka buying the shares of stock. This could include things like money raised during the initial public offering, aka IPO, or subsequent stock offerings. Retained earnings, on the other hand, refer to the profits that the company has earned over time and chosen to be kept within the company, meaning that if they are not paying out the shareholders in form of dividends, these retained earnings can be reinvested in the company to help it grow, or they can be kept as a cushion for future financial needs. It's worth noting that equity can be a little bit trickier to understand than assets or liabilities, since it's more of an abstract concept, but it's an important component of the balance sheet since it represents the overall health of the company. If a company has a high level of equity related to its assets and liabilities, that's generally a good sign. It means that the company is in a strong financial position and has the resources to weather any challenges that may come its way. And that's equity in a nutshell. To sum it up, it's the amount of money that would be left over if the company sold everything that it owns and paid off all of its debts. Now that I've gone over the three main components of the balance sheet, which are again the assets, liabilities, and equity, let's talk about how all of them could come together. At its most basic level, a balance sheet is simply a snapshot of a company's financial situation at a given point in time. It shows the company's asset on one side and its liabilities and equity on the other side, with the two sides balancing each other out. And the basic equation for this is assets equals liabilities plus equity. So for example, let's say that a company has $50,000 in liabilities and $50,000 in equity. What would be the total assets? If you refer back to the equation, assets is equal to liabilities plus equity, this will give us $100,000 in assets because the two sides have to balance out. Now, of course, in real life, balance sheets are usually a lot more complicated than that. There are many dozens or even hundreds of different line items on a company's balance sheet, representing everything from inventory to long-term debt to accrue expenses. But the basic idea is the same. A balance sheet is a way of showing a company's financial health at a given point in time. By looking at the balance sheet, investors, lenders, and other interested parties can get a sense of how much the company owns, how much it owes, and how much equity it has. So that's how all of these components come together to create a balance sheet. So to recap, assets are things that a company owns that can be used to generate value. Liabilities are things that a company owes to others. Equity represents the amount of money that would be left over if the company sold everything it owns and paid off all of its debts. And overall, a balance sheet shows a company's assets on one side and the liabilities and equity on the other side, with the two sides balancing out. Of course, this is just the tip of the iceberg when it comes to understanding the finance and accounting world, but hopefully this introduction to balance sheet has given you a better understanding of how companies track and manage their finances. And if you have any questions, feel free to drop a comment down below. And if you found this video to be helpful, feel free to give it a like, and I'll catch you all later.